For 2.5 years, the entire commercial real estate industry has been waiting on the same thing, a rate cut big enough to actually move cap rates. This week, the Fed didn't cut. That's not the news. The news is that 3 regional Fed presidents stood up Wednesday and tried to remove the language that says rate cuts are even on the table. I'm Kang. I sell strip centers across Central and South Texas, and every Saturday I walk you through the week that was and what it actually means for the property you own or the one you're thinking about selling. 5 things to cover today. The Fed meeting nobody is talking about correctly, the Q1 GDP print that landed Thursday morning, gas prices because the Strait of Hormuz is still closed, consumer confidence, and a number underneath it that matters more than the headline. And finally, the one piece of real data this week that should change how you think about your tenant mix for the next 12 to 18 months. Let's go. Wednesday, April 29th, the Federal Open Market Committee held the federal funds rate steady at 3.5% to 3.75%. That part was expected. Markets had already priced in 100% probability of a hold. The part that wasn't priced in 8-4 vote, 4 dissents. That is the most dissent at a single FOMC meeting since October 1992, 34 years ago. So Governor Stephen Moran was the only one who wanted a quarter-point cut. That's a familiar dissent. The other 3 are the ones to pay attention to. Cleveland Fed President Beth Hammack, Minneapolis Fed President Neil Kashkari, and Dallas Fed President Lori Logan all voted against the policy statement, not because they wanted a different rate today, but because they wanted the easing bias removed from the language entirely. They wanted the statement to read as neutral, as in, a hike is now just as likely as a cut. When one governor dissents on the rate, that's normal noise. When 3 regional presidents publicly break ranks on the forward guidance language, that's probably a pretty good signal to watch. They are telling the market that the path to lower rates is no longer the consensus expectation inside the Fed. Powell himself acknowledged in the press conference that more committee members wanted the statement to communicate, in his words, a neutral stance. And there's the supply shock context. Powell named 4 major shocks in his post-meeting comments: the pandemic, the invasion of Ukraine, the tariffs, and now Iran and the oil spike. With PCE inflation reaccelerating to 4.5% in Q1, the committee is staring at the real possibility that the next move is up, not down. Something to think about with commercial real estate. The 10-year treasury closed Thursday at 4.4%, up from where it traded heading into the meeting. Walk through the math on a refinance or an acquisition today. 10-year at roughly 4.4, lender spread on a strip center loan in the 250 to 275 basis point range, you're looking at 6.9 to 7.25% on a new loan. If you've been modeling a refi in late 2026 with a 5.25 to 5.5% loan rate, that scenario just got materially less likely. Thursday morning, the Bureau of Economic Analysis released the advance estimate for Q1 2026 GDP. The headline, real GDP grew at a 2.0% annualized rate, up from 0.5% in Q4 2025. 3 things did most of the lifting. First, federal employee compensation snapped back after the late 2025 government shutdown. Back pay flowed into the income accounts, and that one item alone added a meaningful share of the acceleration. Second, AI-related business investment surged about 10%. Equipment, intellectual property, software, data centers. And third, government spending rose 4.4% overall, with federal spending up over 9%. What didn't carry the quarter? Consumer spending. Personal consumption decelerated to 1.6% growth. That's the engine of the U.S. economy growing slower than the headline number suggests. The PCE price index inside the same release came in at 4.5% for the quarter, up sharply from 2.9% the prior quarter. Core PCE, the Fed's preferred inflation measure, rose to 4.3% from 2.7%. That is the number that gave the regional Fed presidents the cover to push for removing the easing bias. For commercial real estate, strip center NOI is built on tenant sales, and tenant sales are built on consumer spending, not on AI capex and not on federal back pay. When the consumer line decelerates while the headline accelerates, What you're seeing is a high tide GDP print covering a falling tide consumer. If you own a center anchored by discretionary categories like apparel, casual dining, full service restaurants, or specialty retail, pull your tenant sales reports for Q1 and look at it year over year, not just the same store against prior month. Tenants who are flat to down on a 1.6% consumer growth quarter become tenants who are negative when growth slows further. Vacancy risk shows up 6 to 9 months before the lease expires. AAA's update this past Wednesday: the national average for regular gasoline jumped 27 cents in a single week to roughly $4.27 per gallon. That's $1.12 per gallon higher than this time last year, and it's the highest national average since late July 2022. We're at $4.30 as of today. What drove the jump? WTI crude settled at $106.88 a barrel Wednesday after a $6.95 single-day move. Brent crude traded above $111 Friday morning. The Strait of Hormuz remains effectively closed. The U.S.-Iran peace talks hit an impasse this past week, and the Trump administration is enforcing a blockade on Iranian ports. If there's a silver lining for our markets, Texas is currently the 9th cheapest state at the pump at roughly $3.85 per gallon. That's about 42 cents below the national average. Our refining proximity helps, but $3.85 is still well above where Texas drivers were paying 12 months ago, and the relative discount doesn't insulate the consumer. It just makes the squeeze less severe than what California, Hawaii, or Washington shoppers are absorbing. Think about this. Every dollar above the long-run average gas price is a dollar pulled out of discretionary retail spending in your trade area. The consumer doesn't have the option to drive less. They have to get to work. So the pump price is functionally a tax on everything else in the household budget. That's bad for the apparel tenant, the casual dining tenant, and the discretionary services tenant in your retail center. The Conference Board released April Consumer Confidence Tuesday. The headline number ticked up to 0.6 points to 92.8, the third straight monthly increase and well above the 89 expected. On paper, that reads like a resilient story. Look one layer down, and there's a split. The present situation index, how consumers feel about right now, fell 0.3 points. The expectations index, how they feel about the next 6 months, rose 1.2. The whole gain came from forward optimism, and the survey period coincided with a temporary 2-week ceasefire that started April 8th and the equity rebound that followed. The line worth pulling out: consumers planning more spending on services over the next 6 months shifted from yes and maybe to a flat no in April. Anticipated future spending fell across nearly every services category, including restaurants, hotels, airfare, and beauty. The one category that rose was pet care. Conference Board's chief economist, Dana Peterson, noted that mentions of prices, oil and gas, and war all increased in the open-ended responses compared to March. The mix shift inside services spending is what matters for strip center underwriting. Cheap thrills and necessary services is how the Conference Board put it. Translate that to your rent roll. Nail salons, urgent care, pet care, beauty, fast casual under a $15 check. Those are the categories where consumer intent is holding. Sit-down dining, salons doing $200 services, and specialty fitness at $200 a month. Those are the categories where consumer intent is actively declining. Here's a strong story to keep in mind. Tuesday, Technomic released full year 2025 unit count data reported by Restaurant Business. Independent restaurants in the U.S., the local pizza place, the family-run Tex-Mex spot, the single location burger joint, declined 2.3% in 2025. That is a net loss of approximately 9,500 locations in 12 months. Over the same 12 months, the top 500 restaurant chains grew their unit count 1.5%, adding roughly 3,600 net new units. The chains now represent about 35% of the entire restaurant industry, a record share. Technomic's senior principal, David Henkes, laid it out plainly. Every input cost, labor, rent, insurance, food has risen at mid to high single-digit rates. Margins have compressed materially. Chains have deeper pockets, better procurement leverage, and more capital to weather a 5 to 10% traffic decline. Independents do not. A single bad quarter for one location operator can be terminal, and it's not slowing down. Black Box Intelligence projects 9% of full-service restaurants and 4% of limited-service restaurants are at risk of closure in 2026. Check out your rent roll this weekend. Count your independent restaurant tenants. Now apply a 2 to 3% annual closure rate to that count over the next 36 months and ask whether you're prepared to backfill those spaces in a market where the chains are the ones doing the leasing. So in close, the market spent 2 years assuming the Fed would eventually rescue commercial real estate values through a meaningful rate cut. This week, 3 regional Fed presidents publicly signaled they don't think that cut is coming. Oil is back above $100. Inflation is reaccelerating. The consumer is decelerating, and the tenant base under your strip center is sorting itself into winners and losers in real time. Still, none of that is a reason to panic. All of it is a reason to just stop waiting. The hold versus sell decision in 2026 is not the same decision it was in 2024. It is a different cost of capital environment, a different tenant environment, and a different buyer pool. If you own a strip center in Central or South Texas and want a real no-pitch read on your property and what it would do in today's market, feel free to reach out. My contact information is in the description, and I'll be more than happy to talk with you. Thanks again for spending part of your weekend with me. I look forward to seeing you next week. Take care.